Hi, I'm Nick Hubble, standing in for your publisher James Woodburn for just a little bit longer. He's moved his business trip to Ireland, so you're stuck with me until about the 23rd. I'm joined today, though, by an old friend who taught me to play Aussie rules football. Callum Newman has actually started work at Fat Tail Daily around about the same time, I think, Callum, right?
Absolutely. It's been a long time, a really long time.
So you're actually or you were in the UK around about the same time as our publisher Woody was. I don't think you caught up with him though, and you're on an actual holiday with your family. Take us through what you're up to, Adam.
Well, I've just done a little trip, or a reasonably sized trip to Europe in the last couple of months. Mostly spent in Spain, but I've came through Greece and been to Holland, and we jumped over to London there to see the very important feature of Harry Potter World for my two girls. So that was a lot of fun. And just as an observation, which is what I'm talking about in today's Fat Tail Daily, is all the news that we receive is always slanted negatively. But when I look around, what I'm seeing, I'm just seeing people everywhere and people spending money. Planes are full. Harry Potter's booming. London was full of Americans. And when we went through the airport, I just, as is my want, picked up a copy of the Financial Times, and they just had an article buried in the middle there saying that Heathrow is having its busiest season in history. There's so many people pouring through the place. And so it's anecdotal, of course, but it just says to me that the bearish slant to the news is misguided. Everything I see literally on the ground over here is that things are pretty good.
And it's not just the anecdotal stuff in the media, it's the economic statistics as well. They've got outright stagnation in all these different countries that you've been visiting. In the UK, they just had 2 quarters of zero growth, literally. There's chaos in the streets, if you believe the UK media, regarding the tax policy that the Labour government over there is putting in place. And you're saying this isn't really what's going on the ground. How much of this is the fact that you're effectively a tourist over there, and that there's so many Americans and the strong US dollar, keeping in mind that I'm in Japan because the Japanese yen is so weak. So I guess we're both sort of surfing this wave of currency moves.
Well, look, you're right. I should say the Financial Times had ran the same article about GDP growth being slow in Britain. I must admit, over the years, I've never found GDP growth a useful guide to making money in the stock market. I mean, this is what we're about, right? We want to time the market and all that type of thing. Credit from the banks and house prices generally are going to give you a better guide to what's going on than just the bog standard GDP statistics, especially true in America. I mean, you look back over the last 10 years, American GDP growth was very weak for a long time, but the tech sector was absolutely booming from social media, and they were just making so much money. So GDP and that type of thing can be a total trap. So, but I just thought I'd point it out in the article today, because I think sometimes it helps to go, look, I've been looking around the place, and I wrote a piece for Livewire a couple of weeks ago now, or even a little bit longer, and just pointed out that the European banks, the share prices are rising over here. And in fact, one of them is, I think it's an Italian bank, is now trying to buy a German one. That to me, again, is another little clue that things aren't as bad as some people make out. If you get a healthy banking sector, that means the financial system has to be in pretty good shape. And I saw another post just today before we started here saying that the credit markets over in the US are not seeing recession. And again, today in Australia, the Aussie market hit all-time highs. So when you start putting these little pieces together, you go, well, there's always problems in the world. The market's always going to be climbing a wall of worry. But realistically, if you're holding back expecting some cataclysmic recession, I think that's misguided. So that's all I was trying to point out today. Doesn't mean it's necessarily points to an opportunity in the market. You then have to go, well, how do I take that and find a profitable opportunity in a specific stock or something like that? But for me, the overall framework of how high is the risk in the stock market, I would suggest that now it's still reasonable. We've had a big run up since November, but I still think the Aussie market, with the usual dips and rallies and spooky drops as we can get will keep pushing up for the next couple of years.
Yeah, there's a market historian called Russell Napier, and he likes to point out in almost all of his presentations that there's not much correlation between GDP and stock markets. There's all sorts of other factors that matter more. Good example being a topic that we recently covered in another video, where German GDP and industrial production was absolutely plummeting, but the German stock market was, just like you say, also hitting all-time highs. So there seems to be this divergence. Not so sure that's a very good thing, but it is interesting for investors at least. Some stocks in some sectors will be more exposed to GDP than others. You take us through some of those in the article. You talk about how US deficits could be driving a new phase of growth. So take us through how that might impact different parts of the market.
Well, I mean, you and I have both over the last 15 years constant concern about US deficits. But the reality is they haven't yet proved to be a problem. Everyone's been expecting a debt crisis forever, but hasn't happened yet. It probably will one day. I don't know when. But the facts seem to suggest that when the US government is running big deficits, that it's good for economic growth or good for the market, because every time they start contracting it, obviously it starts to pull money out of wherever they're spending it. So you can get on the end of that spending in different ways. I mean, the most obvious way for the last 20 years is defense spending, because the US pumps so much money into its military. You can ride that wave through ETFs for individual stocks, but the easiest way is through defense ETFs with Lockheed Martin and all that kind of crowd. So that's one way of doing it. Kamala Harris, I'm pretty sure, has a policy to help American homeowners get into the market, which if she gets in and it goes through, is obviously going to juice the real estate sector. So there's all sorts of different ways you can do it. And of course, in the article, I allude to the gold price. So people who criticize the deficits, are quite right in their arguments. I'm not saying it's a good thing long term, but right now, it seems to be driving gold. And there's really no reason to think that's going to stop anytime soon. I mean, the deficit is so enormous now, and the deficits, the accumulated deficit, and then just to keep things, both whether Trump or Harris or whoever gets in, both are going to increase the deficit, if you can believe that. So it's pretty clear, I think, that certainly the Eastern investors, China and Russia, are increasing their gold holdings. I don't think it's going to be long before Western investors start to do the same thing. So I do see a very bright outlook for gold and gold stocks, which are still not quite following in with the way you would expect, considering the strong lead from the gold price. But at some point, I do believe that just the pure profitability of them in Australia, it's going to have to keep driving them up if it continues.
Yeah, when we started our career, I remember the deficit was a big political issue, and everyone was talking about whether we should pursue austerity and stimulus and all these sorts of things. These last few presidential election campaigns, actually, now it's just disappeared. Maybe it's too big a problem for anyone to bother tackling in politics, or it's perceived to not matter anymore. Let's take that more to the Aussie market, because you write that Australia's economy is likely to follow in the slipstream of the US. And so if we have these bigger than expected deficits, or bigger than reasonable deficits, and US growth continues, parts of the Aussie market should benefit from that. Anything other than gold that you might be looking at? I think you wrote about retailers in a recent piece for your Australian Small Cap Investigator.
Well, it depends a lot on your time frame if you're watching this, because there's always a distinction between trading momentum and if you're investing for the long term, and how patient you're willing to be. So the retailers are an interesting one. I do think long term there's an opportunity there, but you have to be very patient because a lot of them are way down off their highs. Some have come back. JB Hi-Fi is a clear standout. So that's interesting. But the gist of that particular piece wasn't so much about economic growth that went out or what have you. It was more to do with a dynamic particular to that industry, and it was the last mile logistic aspect of online sales, and which stores have a pure online strategy and then a mixed strategy of physical stores. So that's where that one was going from. And that led to real estate investment trust, which is a sector that's been smashed around for the last couple of years around interest rates and recession and all that type of thing. But I do think the tailwinds are coming back to that sector. So I've already got the guys in one that actually got a takeover offer recently, but we're going to go into another one. So again, if you're prepared to look out 1 or 2 years, it's a relatively conservative idea this month. Anyone watching this, and if they follow the market, will know that resources are getting absolutely hammered at the moment, generally speaking. So there's a reasonable level of risk in some sectors of the market. So I wanted to be a little bit lower risk just while that's going on. But yeah, there's always opportunities in the stock market. You just got to try and put things into context and what have you. So with the outlook for inflation and interest rates moderating, but huge immigration into Australia, I mean, that makes for a very interesting dynamic for property-related shares.
You're arguing that economic growth is not that directly related to the stock market. Monetary policy, however, is very much directly related to the stock market, and monetary policy should at least reflect what's going on in the economy. So if you're saying that GDP is not going to be as bad as expected, that implies that monetary policy would not be as loose as expected, which shouldn't be good for the stock market. Can you try and square the circle for me?
Well, I mean, I hold the view that monetary policy and central banks are overemphasized in the market anyway. I mean, it's a very easy thing for everybody to follow, and the amount of articles I've read over the last 14 years about interest rates and central banks is like mind-boggling. There's probably some AI you could build off that thing. But again, overall, there's many stocks where you point to where interest rates are irrelevant, or they're just not a factor, or it's just not that important. So, whilst I acknowledge it, to me, it really comes down to studying individual stocks and how they're priced in the market and how that might change. And interest rates are such a broad brushstroke that very rarely do I make any sort of case to do with interest rates. So interest rates are going to swing around. The problem isn't so much the nominal level of interest rates. Usually it's if something causes them to gyrate that the market hasn't priced in, which is what happened in 2022 when suddenly they were supposed to be low till 2024 and then they're screaming up and everyone's going, well, hang on a minute, nobody's factored this in anywhere. That's the real danger. So as long as rates have peaked, and whether they go down 0.5% or 1/4 or 3/4, is in the short term, it might swing things around a little bit. But long term, I mean, if you're backing a business, in 3 years, no one will remember this dynamic about interest rates, and they'll be what they are. But the business may have doubled revenues, but it's not going to be from interest rates. It'll be from sales and all that type of thing. So it depends very much on the type of stock you're trading and looking at and what the opportunity is and all those types of things. And in fact, part of what I say in this issue is, again, with REITs, people call them bond proxies, or they just relate it back to the interest rates. Oh, they're going up, well, REITs go down, and if rates go down, we'll buy REITs. Well, it's just not that simple. Nothing ever is. So there's population growth, there's economic growth, there's credit growth, there's replacement costs, there's construction costs, all those types of things. Consumer demand for different assets. So there's all those things. So if you can get into the slipstream of stock that has multiple drivers, well, then you're looking pretty good.
Well, you've absolutely ruined my last question with that answer. So all I can do now is say, instead of listening to my final question, why don't you check out the article for Fat Tail Daily from Callum Newman today?
Let me just add one final thought from this. For example, the small cap sector has actually been a little bit out of sorts in the last 6 months. But there's been multiple stocks within that sector that have done really, really well. So again, you could sit here and go, oh, geez, that index is just going sideways, and they say recession's coming and interest rates, this or that. Well, the fact of the matter is, if you had bought, I'll use one example, a gold stock called Spartan earlier in the year, you're up hundreds of percent. Nuex, you're up hundreds of percent. Now, of course, there's some that don't work or whatever, but there's only so far a general observation can take you. It's generally down, unless you're trading an index or an ETF specific to one sector, to the individual factors on any one stock. So that's the main takeaway from this discussion.
Yeah, I think within the small cap sector, the gains on offer tend to be so large that the macro environment starts to matter less. And that's the whole point of investing in the style that you in particular do it, by looking at the particular company's prospects rather than the macro side. at least in terms
Absolutely.
of where
The
you
one
start.
exception to that was that 22-23 period where the fear factor was so high about a US recession and high rates that it really did just clobber pretty much everything. But that's a very atypical period. And as we're seeing now, again, even those small caps are still relatively weak relative to the top 50. The market is hitting all-time highs, but if you look below the surface, it's not a booming market. There's not a lot of speculation. There's no big growth narrative. It's very much driven by the big stocks. Within the swirl of all that, there are still individual stories that are very interesting. It's a huge opportunity set. So, I mean, the general gist of what I leave to people is to go, well, even if the US was to slow down, I mean, the market is already braced for that. It's what everybody expects. It's when nobody expects it that you've got to worry. So it doesn't look like that today.
I feel like the converse can happen as well, though, where something that's the opposite of 2022 happens, where monetary policy overdoses on trying to prevent the recession and small caps melt up along with the rest of the market. But because they're small caps, they melt up even more. So those risks do go both ways as well. Anything else,
I would
Callum,
love
you
that
want
to
to
happen. I'd love it melt up. It would make life a lot easier.
Yeah, I bet. It would certainly make you look like an absolute genius. So we'll have to do another video if that's the case. Everyone at home, thanks for watching. Please do sign up to Fact Out Early and don't forget to check out Callum's article. Before you go, I have another announcement. Our publisher Woody has promised me a $10 million bonus if I can double the number of subscribers to Fat Tail Investment Research's YouTube channel. So please like, share, subscribe, and send this video to all of your family and friends. Let's give Woody a nasty surprise when he comes back on the 23rd of September.